Good morning and welcome. I'm John Kosar, and this is your Asbury Research Monthly Teach-In for February 7th, 2025. This is a monthly event, and it's a part of your individual investor subscription. We did not have a live session this month due to an internet outage in our area, so we went straight to the recorded version, which you are watching now. We apologize for any inconvenience. We're going to go right back to our live teach-in next month, which will be on March the 7th. If you're a new premium research subscriber with us, or even if you're not new and you need additional help with understanding our research and implementing it into your portfolio, you can schedule a 30-minute Zoom meeting with us via the link at the top of the Research Center. We're going to go to the Research Center in just a minute, and I will point it out there. If you're a new subscriber and you have not yet had your initial one-on-one Zoom with us, with either myself or Jack, make sure that you schedule it via the Research Center. Just another note, next Wednesday morning, 2:11, I will be interviewed for my monthly Schwab Network interview. They typically begin around 9:15 in the morning Central Time. So if you're interested in that, you could set your alarm for that, and we'll see you on the Schwab Network in a few days. Order of topics. The first thing that we like to do is, for those that are new, and we've got a lot of new subscribers lately, how to use the service. So we're going to walk through all the models. For those of you that aren't new, the walking through the models, I think, is a very good way to get a good comprehensive idea of what we think is important and what we think that you should be paying attention to. So let's move over to the Asbury 6. And here it is. The Asbury 6 flipped to positive. As of February the 6th, we had a wild reversal is what we had. On February 5th, when the market was weakened and it was down at the bottom of the trading range, it went to risk off. After the close on Friday, where the market was up 130, 135 points for the day, it went back to risk on. All the Asbury 6 does, all our models do, is read the data that we've back tested, the data that's been successful with 7 or 8 year look backs. Sometimes they get whipsawed when the market is down as hard as it's been over the past 3-4 days, and then it rallies by 130 points. The A6 or myself or anyone that I've ever met is not smart enough to see that coming. I looked through the news. There really wasn't any blockbuster news other than we got down to the bottom of the range in the S&P 500 and we bought the dip, which is what we've been doing since October. So anyways, heading into Monday, the A6 is back to positive. The advantages of the A6. The A6 is active. It trades about 10 round turns a year. By round turn is one positive to negative move is one round turn, about 10 times a year. But the maximum drawdown in the A6, which has managed to stay right with the S&P for the past 8 years, is only 17%. The maximum drawdown in the S&P has been 34. So less than half of the drawdown. The noisiness of the A6. What I wanted to do this morning is let's take a look at those charts, because I know a lot of people wonder, doesn't the model work anymore? The model works fine. The market's very, very choppy right now. So the advantage of using a systematic, data-driven methodology like we do is that we just follow the model. We're not trying to predict. We're trying to move where the market moves. Let's look at each of those 6 Asbury 6. And I'm doing this. I usually don't do this, but I'm doing it today because I want you to kind of understand what's going on underneath the hood of the A6. So so we're going to go through all six. This is the S&P 500 up top. This is the monthly rate of change in the S&P 500. So you can see that's still negative. It dropped hard here last week, and even though we had the big up day on Friday, it is still negative. It's underneath its 21-day moving average. Why the 21-day, John? 21 days is a business month, and that's our tactical time period. This is the relative performance of stocks versus high yield bonds. We use SPY for stocks, and we use JNK for high yield bonds. They're both ETFs. And here it is here. You can see on Thursday, we were well below the 21-day moving average as we were here in November, and as we were here earlier in the year, it came roaring back on Friday, and now we're back up above the 21-day moving average, so that one has turned back to positive. This is the assets under management, the AUM, in the S&P 500. You can see it dipped down below its 21-day moving average on Thursday and went roaring back on Friday. This is another positive. This is VXX, which is a futures-based derivative of the VIX. We like to use that for this particular model because it's a little less jumpy than the VIX is, but that is still negative. Note that when it's above the 21-day moving average, it indicates, just like the VIX, when the VIX is rising, the market's nervous. So it did pull back a little bit, but this is still negative. This is number 5 of 6. This is the cumulative volume index. It's if those of you out there that are technically oriented, it's very similar to on-balance volume. It's cumulative volume, as the name suggests. Crashed down through the 21-day moving average on Thursday, indicating that volume is drying up. It edged back above the 21-day moving average on Friday. This is the third green, if you will, for Asbury 6. And note that it's right on this 21-day moving average. It can move back to negative tomorrow, or this will be Monday, of course. But all of these are pretty close to their averages. So, and then finally, this is the NYSE Advanced Decline line, and that has been pretty solidly up above here since January the 5th. It tested that 21-day moving average on Thursday. It looked like it might break down through it, and you could see we gapped up on Friday. So that is the status of the Asbury 6. The next thing we're going to do is we're going to go back to the website, and we're going to move over to the CPM, the correction protection model. And that is right here. CPM. It moved to risk off as of the close on Thursday. Heading into Monday, it is still risk off. The CPM is meant to be or the A6 rather, is meant to be kind of an EKG for the stock market. We want it to show or be wiggle. CPM is different constituent metrics, and the purpose of the CPM is to keep you long, to keep you in the market as much as possible, because the market inherently goes up. So again, like I said, risk off as of 2/6. Let's look at the chart. So there's our risk off, and we'll see what happens next week. But again, heading into the new week, we are still risk off, despite the big day on Friday. Year to date, CPM is down 0.06 year to date, trailing the S&P 500 by 1.34%. Again, it's February, it's a long year, but it's effectively even for the year, despite the big move up on Friday. It's meant to replace the 60/40 static stock bond portfolio that, if you've ever used an advisor, you probably were recommended to get involved in something that's kind of a 60-40 portfolio. Let's go back to the charts here and let me show you. Good. So AOR is an ETF that is meant to emulate a 60-40 stock and bond portfolio. That is blue. It's down here. This is CPM up here in green. And so the purpose of a 60-40 bond portfolio, even though it doesn't really work all the time anymore, was to kind of statically have you mostly in stocks. So when the stock market goes up, you can profit by that. But then the 40% bonds was with the assumption that if the stock market is going down, people are going to move into bonds and you would have some protection. So basically, this is a static protected portfolio. With the CPM is a dynamically protected portfolio. The CPM changes when the market changes. So right now we want to risk off. Anyway, this is what the chart looks like going back to inception for us, which is Q4 of 2017. And you can see just how much better the CPM has performed than that AOR ETF, which is the 60-40 portfolio. CPM basically stays with the market with less risk. We talk a lot about drawdowns here. Many of our clients are older, they're wealthier, and they're a lot more risk averse. They're a lot more unlikely. They're more likely to have a bad night's sleep when the market is jumping around. And when we started Asbury 21 years ago, so one of the first things when we started to do retail business was we asked subscribers what they wanted, and they said nirvana for me would be if I could be involved in the S&P 500, if I can be involved in the stock market, but do it with less risk. So this is the first model we've ever built, and that's what this does. Why are drawdowns so important? This chart shows that with a 10% drawdown here, you need to make 11% on the way back up to get to where you were. For perspective, during COVID was a 34% top to bottom drawdown in the S&P. So we'll look at this one here. 30% drawdown in the S&P 500 or in any ETF or any asset. You need to make 43% on the way back up in order to get back to even. This is why drawdowns are so important. I always equate it to football, Super Bowl Sunday, so it's appropriate. When you're in the first half of your investment football game, maybe you're in your 30s, you're in your 40s, a lot of that is dollar cost averaging. Every time you get paid, you buy more stock. And then over time, you have this nice cross section of what the market's done for that 20 or 30 years that you've been investing. Once you get up, I should say my age, I'm in my late 60s. A lot of my clients are of my generation. We're baby boomers. Once you get our age, now you're in the fourth quarter of your investment football game. In the fourth quarter, you don't throw the ball up in the air. You don't handle the ball behind the line of scrimmage. You don't want to make a mistake when you already have a lead. All of us have some kind of a lead going into our fourth quarter because we have money to invest. So we don't want to blow that. We don't want to fumble the ball. So you give it to your big fullback and you take what the market gives you. You take what the defense gives you, so to speak, and you run the clock out. That's kind of where we are here. Here's another chart just kind of showing year to year going back to 2018. 2018, the S&P drew down 15.1%, CPM drew down 15.1%. The broad market S&P 500 drew down 1980. Significant, 4% ish. Some years it doesn't matter that much. In 2019, the S&P drew down 680. CPM only drew down 4%. Here's where it matters. In 2020, the S&P drew down 33.9 to only 9% for CPM. Last year, 2025, drew down almost 19% in the S&P. The CPM only drew down 930. So that's the importance. That's why we stress the drawdown so much. Let's go back and have a look at the CEF model, what the CEF model is doing. CEF model, the CEF is an acronym for sector ETF asset flows. Our latest signals as of the end of last week are right here. We are in energy, we're in industrials, and we're in healthcare. How do you trade this? If you want to trade it according to the model and how we back tested it, we are always invested in the top three, and they're based on a scoring system in 3 different time frames: trading, tactical, and strategic, that Jack and I developed years ago, that keeps us in the places where the money is going the fastest, and it's keeping us out of the places where the money is coming from. So we want to avoid communication services, consumer discretionary, and technology here down at the bottom, and we want to focus our attention up here. So you're always in the top three. So next week, let's say hypothetically you're a brand new subscriber, and next week you're going to take your hypothetical $100,000 account. The money doesn't matter. It's just, I'm trying to make a point here of how we divvy that up. And you will be invested in that, and 1/3 of that, $33.3 thousand in XLE, and the same amount in XLI, and the same amount, excuse me, in XLV. Next week, if XLV falls out of the top three and XLP rises into that top three, that following Monday on the open, you're going to sell out your XLV at the market, have a resting market order at the open, sell out the XLV. As soon as the proceeds from that come back a second later, take that money, allocate it into XLP. That's how we actually trade the CEF model. Since inception, here, let's go back here. So since inception, here's the S&P 500 in blue. Now the inception of CEF is about the middle, well, it's at the end of June of 2018, because that there was a couple of changes to the sector spiders, and we need to wait for, I think it was XLRE real estate and maybe XLC communication services. Those two kind of came to the grouping late. We had to wait for those to normalize, and that was about mid-2018 when we were able to view them together, and there was enough data for those two newcomers so we could blend them into the model. But you can see what we've done here. Blue, S&P 500, green, CEF. The CEF model does not make money every year. The CEF model makes money when there are a couple of breakaway outperformers. What the CEF does do on the years that it's a normal year and the 11 sector spiders basically stay kind of in a pack and go around the year. Think of it as a horse race. Those 11 sectors stay in a pack and they go around the track basically together, and one wins by a length, one wins by a neck, one wins by a nose. That's a normal year. During those years, CEF typically stays within 3% either way of the S&P 500 with a lower drawdown. The years where there's an outperformer, where one of those horses breaks out of the pack, those are the years that CEF really does well. So that's what the chart looks like. Let's go to the table here while we're here. So here's CEF since inception. So we've got the S&P 500 here. Since inception, S&P, the SPY, we're using SPY for this because we want to go ETF versus ETF. 12.79% annualized return. Again, this is going back to 6/25 of 2018 versus 20.41 for CEF. So annualized, it's outperformed by 7.62%, and it's done that with about the same standard deviation and about the same beta. So S&P 500 risk, but much better performance. Let's take a look at SPY since we're in the, or I'm sorry, CPM since we're on this chart. Again, this is going back to 9/29 of 2017 for the CPM. So annualized since then, CPM has trailed the S&P annualized by 0.7% a year, but it's done that with a maximum drawdown of only 20% compared to 34 for the S&P, significantly lower standard deviation, and a significantly lower, almost half the beta. So this is how those two models kind of work together. Let's look at, let's go here since so this is since the beginning of the year, right? So this is year to date. We're 5 weeks into the new year. CPM trailing by 0.06. I mentioned that earlier versus 1.28% for SPY, trailing year to date by 1.34. CEF, the S&P is 1.28% year to date. CEF is up 7.74% year to date, outperforming by 6.46. And again, it's early. It's, we're 5 weeks into the new year. But I like to show them together because a lot of investors, a lot of subscribers, I should say, like to use them both. So if you use them both 50-50, let's say you have a hypothetical $100,000 account, 50,000 of that is in CPM, 50,000 of that is in CEF. They tend to work well together because CEF is an alpha generator and CPM is a defensive model to keep you from taking a big drawdown. When you put them both together, we call that Asbury balance, and it's actually one of 4 model portfolios that we use for those who prefer a managed account over research. So you can see this Asbury balanced is outperforming the S&P by 2.52%, which again is that 50-50 blend. Let's go back and look at the CART model. Pardon my cough, I've got some allergies going on here. Let's go back and shift over to CARP. So now that we're in the Research Center, for those of you that haven't gotten an initial Zoom call with us, this is where you sign up for it. Right here at the top of the Research Center, if you have questions about any aspects of our research models portfolios, click here, and that will open up to a calendar where you can pick a time and a date that's convenient for you, and we will meet on Zoom. We'll spend 30 minutes with you, and we'll try to get you up and running faster. Or if you're an existing client and you just have a few questions, that's where you set up, some one-on-one time with us. So let's go to CARP. And what CARP is, is it looks at 8 different relative performance comparisons on the equity side and 3 on the fixed income side. So the excuse me. So what CARP tells us is where the outperformance is. I'm going to here we go. It shows us where the relative outperformance is. So in this case, we've got stocks and bonds are kind of waffling back and forth. We don't have a clear leader. Here we have high beta and low volatility. There's not really a clear outperformer there. Small cap has been outperforming large cap across all 3 time periods, trading tactical and strategic, really since the beginning of January. You can see this in the strategic. 1-2 is January 2nd. Blue chips are outperforming the S&P 500 right now. That's typically defensive. The broad market the broad market being the S&P 500 is outperforming technology, the NASDAQ 100. That's typically defensive. Value outperforming growth. So what we have here is kind of a bifurcated market. Some of these relationships are negative. Some of these relationships are positive. How do we interpret that? The market doesn't know quite what to do here. And you can see that if you look at a chart of the S&P 500, here is one. You see the S&P 500 since October 29th, which is where I'm at right here with my mouse, outside of a few weeks where it tried to get higher and stay there and failed, it's been sideways. We're actually on October the 29th, the S&P finished at 68.91. On Friday, the S&P finished at 69.84. So pretty much where we were 3 months ago. Going back to CARP, that's what this is showing us. There's really not a clear where all of the relationships are defensive, all of them are offensive. And we do the same here for fixed income. Down below it, we have the US versus the world model. What that does is that measures the relative performance of 25 different global markets, global equity indexes against SPY. And we have them broken down into geographic regions. So we've got South America here. We have the continental US with Canada and Mexico here. We have Western Europe here. We have Asia Pacific here. We have the Middle East here. And we have Oceania down here with New Zealand and Australia. What's basically happened is in August through October, we started seeing outperformance in South America. After that, Canada and Mexico started to outperform. You can see here November, middle of November. Then once we got into latter November and into December, Western Europe kicked in. And then like into January and early part of February, we had the Asia Pacific start to outperform. So it started in South America and it worked its way across the world, which is why we're seeing a lot of relative outperformance in different places over the globe. Let's go back here. And then how you read this, how you respond to this, down at the bottom, it shows you the three best relative performers, outperformers versus SPY currently. And then down here are the ones that we chose as overweights because of the risk reward characteristics were so good. So that's basically how you use this. Let's flip back over here and look at the chart. We're going to show you SPDW, which is the Spider S&P World Equity Index ex-US, excluding the US. And here's its relative performance versus the S&P. You can see that since October, there was really no comprehensive relative outperformance by other indexes, developed world indexes. But this started to kick in hard here January 2nd. And since January 2nd, SPDW has outperformed SPY by 5%. That's the outperformance that we're seeing, but we're looking at it as an index rather than individual countries starting to trip over one by one by one by one, like we showed you with the US versus the world model. Let's move back here. And next thing we're going to look at is our ETF trade ideas. So these are trades, as the name suggests, rather than investments. What we try to do with Asbury Research is to put a bunch of different tools out there. CPM is defensive. A6 is an indicator. CEF is a sector rotation alpha generator. A lot of different ideas so people can pick what they're most interested in. These are all collectively not meant to be one big portfolio. People make that mistake. I kind of look at it like a smorgasbord. If you go to a buffet, you've got a lot of things on the table. That's kind of how we look at what we do here at Asbury. It doesn't mean that you put everything on the buffet table on your plate. You pick the ones that you like and you use those, and that's kind of how we see here. But the way this works is we've been putting these out. We have a very mechanical way of determining which of these we want to be invested in. Jack runs a scan, quantitative scan through 6,600 ETFs every morning. When I get at my desk at 6 a.m., I have them in front of me. So maybe out of 6,600, you might have 10 or 12 or 5. What I do at that point is I look at them all from terms of risk reward. Using my experience of trying to understand where risk reward is. I worked in the pit for 17 years in the 80s and 90s at the CME. So that's the only discretionary part of this. And I picked these out. And what has happened over the past, 34 months, from March of 23 through just a few weeks ago, we've had 120 trades. That comes out to about 1 trade a month. They're not on the calendar. We're not, well, it's Tuesday, we've got to pick a new idea. It's just how it's turned out. About 4 a month. Maximum drawdown on these is only 3.7%. So they're very, very risk averse. The Sharpe ratio on this is 1.4, which is a extremely good Sharpe ratio. Sharpe measures risk-adjusted returns. So not only I made this much, but I made this much and only risked that much. That's what a high Sharpe ratio is. A Sortino ratio of over 2, you could look these up on Investopedia to get a better understanding. These are extremely good risk-adjusted numbers. Percentage of winning trades, 54%. Our average winning trade is 5.5% profitable. And average trade is about 20 days. We're in the average winning trade about 20 days on average. Average losing trade, we lose only 2.4%, which is less than half the winning trades. And we're in those losers about 8 trading days or about a week and a half. The ones that we currently have going on now, we've got CUT, EEM, and XES. And I'm going to go through those. I'm going to go through the entire models monitor in just a few minutes, and we'll look at these and we'll look at everything that we have open, so to speak, in terms of open ideas. But I wanted to let you know how this works. If there's a if there's a new idea, you're going to get a branded email. It's going to be called an Asbury alert. It's going to show you a chart of the idea. It's going to lay out the risk reward for you. And if the idea is stopped out, let's blow this up again. Valid above and below is a soft stop. So that means for CUT, the Global Timber ETF, if it drops through 30, that an alarm goes off in our office and I start watching this possibly get out of the trade. It doesn't mean that these are not hard stops. They're meant to be, they're not meant to be used as hard stops. They're meant to be used to tell me that the validity of the trade is now suspect. And I keep an eye on that. You should be doing the same thing. There's a million different stock market alarms out there. Find one and use it. And if we get out of that trade, we do not send an email, but we will change this to show that we were stopped out of that trade. And the way that you know that a change has been made in this table is if you go back to the research center and you'll see that the latest change that we made to this table was yesterday, Saturday, February the 7th. On Monday, if we don't put any new ideas out and you see that the date has changed to Monday's date, that means something has changed in that table. You want to go in there and look at that table and see what's yellow. Those are going to indicate the changes. This indicates that these two stops were ratcheted up on Saturday. After the week was done, I looked at these two and I said, I think we could reduce the risk a little bit. So we use traveling stops to try to lock in a profit as fast as we can. So enough said there. Let's go over to Market Monitor. And all this is we've had people say over the years, there's so much stuff here, it's hard for me to get through it all. Um, I don't have the time to go through all of this, or I don't want to. So thus, Models Monitor. Models Monitor is updated once a week on the weekend, and all of our latest trade ideas, let's call them, actionable ideas are all here. Here's our Asbury 6 and CPM under when to be invested. It tells you whether we're negative or positive and what we're doing and from the date and how well it's doing so far. Here's our CART model for where to be invested. These are the 3 best performers in the CART model. Developed markets are outperforming SPY. High beta is outperforming low volatility. And value stocks are outperforming growth stocks. Sector rotation, here's our CEF model. Here's our CEF Ultra. So those are all the current ideas there and how they're performing. Here's our ETF trade ideas. And down here is international. So let's move over here and have a look at these. So you can equate what you're seeing in Models Monitor to kind of what the chart looks like. I thought that would be a good exercise for today. So here's CUT. It's the Invesco Timber ETF. It's basically a lumber and building materials ETF. So you can see we put the idea on right here, which is February the 5th. That's what the white arrows are. Up here is the raw chart, or the actual chart itself. Down here is its relative performance versus SPY. Everything that we do is measured versus SPY. In my world, I'm not going to tell you to go out and buy just materials, say. And materials is underperforming SPY. Why? Even if it's going higher, if it's not outperforming SPY, my job is to give you ideas that can outperform the market, because you can just go buy SPY, cross your fingers that you don't have a 35% drawdown, and you don't need me. So everything that we look at is relative to SPY. We're trying to find ideas that outperform the U.S. broad market. So that's CUT. You can see CUT is coming up to a resistance level here. If we get through it, we're going to have a lot of room to go higher. So CUT is from ETF Trade Ideas. Here's DIG. These are all alphabetical, by the way. That's why we're going from one model to another, so to speak. So this is DIG. This is ProShares Ultra Oil and Gas. This is a CEF Ultra idea. We put this idea on right here on 2/2, which was 1 week ago Monday. And you can see it's risen so far by 13%, and it's outperformed the S&P 500 by 14%. So this comes right from CEF Ultra. Okay, this is EEM. This comes back from from ETF Ideas. You can see we bought it here on the white arrows on 127, and we're still in that trade. We've got a small we got a small loss of less than 1%, 0.4%, 0.5%, and here's its relative performance versus the S&P. ENZL, ENZL, is New Zealand investable market fund. This comes from U.S. versus the world. You can see that we put an overweight on right here on the white arrows, right there, and it's outperforming, and it's starting to make some money outright right there. 2.6. As of 2.6, we're up 1.6%. And note that it's breaking out. It's a big deal. That means now it should have some room to be able to run a little bit. This is Germany, also from U.S. versus the world. We put an idea out to overweight Germany here on 12/22, the white arrows. Through the end of the week, it's up 2.81. And it's outperforming the S&P by just a little bit, by 1.95. Let's call it 2%. EZU, that is another one from U.S. versus the world. It's basically a European index. We put the overweight idea on through U.S. versus the world on Jan 5th. You can see it's up outright. Let's call it 2.7%, outperforming the S&P 500 through the end of the week by 2.3%. RXL, RXL is brand new. This is on CEF Ultra. There's information about CEF Ultra, by the way, if you go to the CEF rectangle up at the top of the research center. So this is a new one. That's why we've got an orange arrow here on a day where there's no data, because this will be executed for those that want to do it on the opening on Monday. This is small cap. We've been favoring small cap for some time. This comes from Keys to This Week. Down at the bottom or up at the top of Keys to This Week, you'll see size and style. Size is small, medium, large, and style is growth or value. So this comes from Keys to This Week. So this has been outperforming, green arrow down here. It's outperformed the S&P since 12/3, these three, by 6.5%. And now it is also breaking out to new all-time highs. So this comes from Keys to This Week. Here's the style part, growth or value. So we've been overweight value from right here, from this green arrow. You can see it really hasn't done a whole lot versus the S&P, starting to outperform right now, but this is since November 13th. So for those of you that instead of wanting to be in the plain vanilla S&P 500, you'd rather choose something from the style and size spectrum, again, this is part of Keys to This Week up at the top. If you don't know where to find any of these, email us and we'll help you. So this is outperformed by 3% since Thanksgiving time. This is UXI. This is UXI. This is relatively new. This is from CEF Ultra. You could see that we got into the trade here. It's risen by 8.3% outright, and we're outperforming the S&P by 7%. XES is one of those ETF ideas that we looked at, the ones with the high Sharpe ratio and the very low drawdowns. We put this idea out to you as a subscriber on Jan 14th, right here. Since then, it's risen by 15%, and it's outperformed the S&P during that period by 14%. Note that it's making a big breakout here. Big breakout going on here. So this has legs. This is from the energy space. CEF has been overweight energy for several weeks. All this ties together. CEF is looking at asset flows. This is looking at different criteria, but with different criteria, we're coming up with the same answers, which is really, frankly, the sign of good research and looking at the right stuff at the right time. This is XLI. This is part of CEF. So CEF overweighted XLI here on 226. Since then, it's risen by 4.8%, outperforming the S&P by 4%. And finally, here's XLV. This is a new one. This is the new one for CEF, not CEF Ultra, but standard CEF. That's why the orange arrows are here where we don't have a bar yet. So again, don't necessarily try to use all of these ideas. Again, it's like going to a buffet. You don't have to eat everything on the table. Find the ones that work for you. Build a portfolio out of those. Like the Asbury balanced portfolio is half CEF and half CPM. We think this is the best way, is to pick the ones you want and blend them into a portfolio, see how they're performing. Maybe you want to add a little bit more of one and add a little less of another. But this is building a portfolio for all of you subscribers individually is just beyond the scope of what we can do with the subscriber part of our service. In addition to that, we started to offer managed accounts to both individuals and other RIAs in the middle of 2024. We created 4 model portfolios with different risk-reward characteristics, using our own models as building blocks, and then we began offering them to investors in 2025. We have individual investors working with us as well as other RIAs that are giving us part of their assets under management that they're managing for their clients, having us manage a portion of those with our models. Let me go back and show you that table here so you just have an idea of what we're doing. Okay, so this is since 1/2 of 25. So we got about 13 months here. CPM, um, I'm just going to show you how these are all doing. CPM in 13 months, trailing the S&P by 2.55%. But again, the drawdown last year was half of the S&P. Standard deviation is lower and beta is lower, basically giving you the S&P 500 with half the risk, which is what this is for. CEF, trailing by 1.5%. But again, CEF has had a spectacular couple of 5 or 6 weeks here. Over time, CEF tends to outperform by around 7%. Our CPM Ultra is over the past 13 months outperforming the S&P by 2.59%. Our Ultra Conservative is, as the name suggests, super conservative. I think the drawdown over this 13-month period was only 6% compared to 19% in the S&P. It's trailing by 5.35%. Ultra conservative historically trails the S&P again by about 3 to 4% annualized, but drawdowns are minuscule. Standard deviation and beta are a third of what the S&P 500 is. It's for people that the T-bill at 3.7% is not giving them enough juice to be able to satisfy their needs. The S&P at 12.5%, but with the potential of a nasty drawdown is too risky for them. This is meant to get right in the middle, and that's what ultra conservative is. Our conservative, right even with the S&P 500 over the past 13 months, Asbury Balance, which is that 50% CEF and 50% CPM, outperforming by about 2%. In our Asbury Aggressive model portfolio, which is the most aggressive one that we have, that drawdown, by the way, has only been about 22 or 23%. Maximum drawdown since inception. That is outperforming over that 13-month period by 5.3%. So enough said there. Let's get back to looking at more charts, and we're going to go through all of the keys to this week. So here's keys. This is once a week. It's typically by the end of the week. It's typically when this goes out, usually Thursday or Friday. It's really based on data. A lot of times I may want to do keys on Tuesday or Wednesday, but I look and there's a big earnings report coming out on Thursday or jobs on Friday or whatever it might be. So you typically see this on Friday. SPX is tactically negative below 68.81 to 69.20. I wrote this in the morning on Friday, so it was before the huge move up, but we're still hanging right around that 69.20 area. If you look at the S&P 500 here, we're at 69.32. This little rectangle was that target, with 69.20 being the top. So we'll see what happens Monday. There's a lot of volatility in here, but remember, looking back, we're right where we were when we set that peak on October the 29th. There's a whole lot of drama going on here, but not a whole lot of direction. And remember, what CPM is for is to keep you from taking a big drawdown, because we know the market historically goes higher most of the time. So overview, we talk about the tactical part of the market. For us, tactical is 21 days. Strategically for us is 63 days. Economically, what we do, now this is something new that we've added. We try to put all these different keys kind of into a basket and try to determine what they mean collectively. So economically, the combination of key factors points to a cyclical risk-on reflationary environment, broad expansion with improving activity, and firming inflation expectations. The implications favor cyclical, small caps, value, and non-U.S. and commodity sensitive exposure, which is your oil. Um, XES is what we're long. We see there's been a lot of outperformance in overseas stocks, even as near-term price action reflects tactical caution rather than structural weakness. Um, Size and style is right here. We talked about value and we talked about small cap. Here's our market sectors. Here's SEAF, here's CARP, and here's US versus the world. What we do is we put our 10 keys to the week into this graphic to try to see where most of the directional impetus is coming from. And as of about 10 o'clock in the morning on Friday, it was mostly tactically negative. Let's look at support here. 68.81 is a 50-day moving average. So we were below it for a couple of days, suggesting the trend was changing down. We held this January 20 low on Friday or on Thursday. It's at 67.89. So we should be watching the 67.89. If we get back down there and break it, that would be a failure of the market to be able to follow through on Friday's rally. Major support is down here at 64.61. Lots of room for the market to correct and still hold the 200-day moving average and still keep the major trend up. This is the SOX index. SOX is semiconductors. When big cap tech started to underperform, I'm looking around saying, okay, what's going to take the baton? And so we still have the leadership we need for the market to go higher. So far, it's been the SOX. The SOX initially broke out on Jan 5 right here. Target's 86, which is about 12-13% higher than where we are right now. You could see we came back and retested the breakout late last week, and then we had a strong day up. 73.93 is the level to watch in SOX. If we break down through it, this pattern failed, which means the market changed its mind on the direction of semiconductors. As long as 73.93 holds, targets a move to 86. Here's the A6, which we already looked at. 5 of 6 are currently red. Actually, 4 of 6 are currently green, because this was from, if you recall, this is from Friday morning. We only had Thursday's data. The A6 right now switched back to 4 green and 2 red. This is volume. We already looked at this chart, so I'm going to bypass it. We looked at this one as well earlier because they're both pieces of the Asbury 6. This is SPY versus AG, stocks versus aggregate bond index. You can see each time that the 63-day trend of outperformance by the S&P 500 was tested, October 10th through 16th, tested and held. Nov 20th, tested and held. D17, Jan 16, and right now. Each of these turned out to be a tactical bottom in the S&P 500. As long as this trend stays intact, market's going higher, and the CPM will readjust and we'll get back in. If we fail here, if we fail early next week, and this relative performance line starts to roll downward, meaning stocks are underperforming aggregate bonds, that's a problem. We're probably making a top. So this is really important to look at. This is small cap. We had mentioned small cap. We've been overweight small cap since December the 3rd. Nice outperformance. We're in the right spot. This is value. We've been overweight value since November 13th. Hasn't done a thing in 2 months, starting to outperform. So that is also working for us. RSP is equal weight S&P 500. The equal weight typically outperforms the S&P 500, or it outperforms growth when the market is uncertain or when it's starting to go down. There's no absolutes in the markets, but typically this is a defensive alignment where you have outperformance by equal weight stocks. This is SPDW, which we already looked at this in a live chart, outperforming since the very beginning of the year, indicating that the US is basically underperforming the rest of the world. Typically, that happens in a market that's either finishing up. That happens when the S&P 500 is at the top of a trend, near the end of an uptrend, or in a downtrend. That hasn't happened yet, but that's what's happening thus far here. So this is a little bit of a yellow cautionary flag for me regarding the U.S. market. So now we went through keys. And last thing we're going to do is we're going to go through some live charts. We're about an hour in. And I prepared some live charts for us to look at to finish up with today. And these are in alphabetical order. So there are no order here where I'm trying to tell a story, alphabetical order. So we looked at SPY Ag already. So we're going to pass by that. We just looked at that as a part of keys. This is Brent Oil Fund, BNO. You can see big, long downtrend here that we've broken. This downtrend started, so this is oil, started in June of 22. We're starting to break out of that here. And look what else is happening. Since Jan 7, this has outperformed the S&P 500 by 14%. So we have exposure to oil. CEF has gotten us into XLE a few weeks back. That's making lots of money for us on a relative basis and also outright. And we're in that IEF, I believe was the name of it, as a industry group within energy. So we do have some exposure there. This is the comp. This is the NASDAQ Composite Index, flat as a pancake since October 29th. Kind of where the S&P is, really. I mean, the S&P is exceeded by a hair. It's a October high, but look what it's been doing versus the S&P. Since November 3rd, it's underperformed the S&P by 4%. That generally, when tech starts underperforming, it raises a red flag for me for the broad market. Meanwhile, here's the Dow 30. Dow 30 is making new all-time highs. And let's go back to here. Since December the 9th, the Dow has outperformed the S&P by 4.22%. So Dow's outperforming the S&P by 4. The composite index, the NASDAQ composite index, underperforming SPY by 4%. That generally happens when the broad U.S. stock market is either very uncertain or making a peak or in a downtrend. So again, this isn't going to be enough for me to go bearish, and we don't make market calls. We read data. We leave the market calls to the guys with the nice suits on television. All we're doing is reading data. The tactical data, as long as it tells us we need to still be in the market, we will. But a lot of this ancillary stuff, these relative performance relationships, are characteristic of a market that's either real tired on the upside or starting to roll over. Here's another one. GBTC is the Bitcoin ETF, and we're looking at it relative to the S&P 500. We don't trade Bitcoin in our shop. I don't really understand it. I don't know what the underlying is. There's no earnings. There's no anything. But what we do use it for is a barometer. When I look at the S&P 500, that tells me what the broader, more sophisticated investor is thinking. When I look at GBTC or Bitcoin, that tells me what the layperson is, the person that doesn't follow the markets, the one that doesn't understand markets, the guy down the street, who's your plumber, or or he's your he's not close to the financial world. That's what he's thinking. So since basically unsophisticated money is what I'm trying to spit out. Since October the 6th, Bitcoin has underperformed the S&P 500 by 50%. So again, I kind of this suggests to me that blind risk appetite has really receded. The market's gotten a lot more careful. You can see that they're buying the Dow. They're not buying, the NASDAQs anymore. All this kind of tells the same story. Here's MAGS, the MAG 7. MAG 7 has been underperforming the S&P 500 since December 23rd by 8%. This is the NYSE. I look at the NYSE as kind of a cousin of the Dow. It's typically a more stodgy, a little less risk on kind of an index. And it's been outperforming the S&P since December 9th by 6%. So if all I did was look at these relationships and I didn't know what the S&P 500 was doing, I'd say that we're either getting real tired on the upside or we're starting to roll over. Here's another one. This is the NASDAQ this is the S&P 100 OEX versus the 500 SPY. Typically in a healthy bull market, the 100 is going to outperform the 500. That's not what's happening. Since right here, these 11, OEX has been underperforming the S&P on a 63-day basis by 1%. But again, upside down from what you would expect in a healthy bull. This is the Schwab US Dividend Equity ETF, and we like to look at that versus SPY-G. So the dividend stocks typically underperform in a risk appetite sort of an environment, a healthy bull market, I guess we'd call it. But look what's going on here. It's outperformed. Dividend stocks have outperformed growth stocks since 12/23 by 17.5%. What's holding us up? Well, the SOX, semiconductors, AI related, has been outperforming a lot. Is it enough to hold the market up by itself? I don't know. We're starting to get some participation from energy and materials and industrials, so it is getting some help. But again, the grand scheme here, as I look across, a lot of these relative relationships, which tell me often a lot more than the S&P being up 100 today and down 100 tomorrow, that a lot of this market is apprehensive and it's losing its appetite for risk. One last thing to pay attention, and then we're going to call it quits for today. This is the 10-year note. This is the US 10-year. This is the yield of the 10-year note. It's an index that tracks the yield of the 10-year note. This up here is back in May of 25 when the yield of the 10-year was up at 5%. Full disclosure, I bought some CDs up here because it was a good way for me to be able to spread my bets around, so to speak, and take advantage of an unusually high long-term interest rate that we hadn't seen in a while. Since then, note that it's kind of created this trend line on the way down, and now we've broken higher from this trend line over the past couple of weeks. That yield is about 486. It's about a 46 yield. 5% is a big deal. 5% is not only the highs that we made here in July of 25 and May of 25, and here in October of 23. But if we look outward, let's go to a weekly chart here. That is the benchmark high that we made in June of 09 at let's call it 507 yield. So if we break through this area here up top, yields could go a whole lot higher. That would fit in maybe with an inflationary theme. Again, we don't like to forecast. We're just trading our models. We're trading the data. But I do want to look across the horizon and see how things are setting up. If this breakout means that we're going to revisit 5% and we exceed it, it could be a major happening. It could be a major development, whether it happens next month or next quarter or next year. Through this 5% area is a really big deal for benchmark long-term U.S. interest rate. So again, is it tradable right now? No, but it's something to keep in the back of your head as as we as we move further into 2026. So again, research product is not for everybody. We know that, which is why we started to manage money. Vast majority of people that become our research subscribers is because they see us at Fidelity or Schwab or Investors Business Daily, and they like the data-driven and very disciplined approach that we employ. The vast majority who cancel their subscriptions with us is they can't figure out how to take the research and integrate it into their portfolios. They don't have the discipline to act on the signals or only take the signals that they like, which usually ends badly because now they're not following the models that you're paying us for, frankly. If you like the model approach, follow the models, and because at least we've got extensive backtesting on those, and we have an idea of how they may perform in the future. Past performance does not equal future performance, but it does give us a stress test of our idea to see how robust it's been with the 7 or 8 year look back. If this is you and you're having trouble trying to fit this into your portfolio and get everything to work together, book a Zoom with us and let us try to help you. Look for the weekly wrap up on Sunday. Let us know if these are helpful to you and what you'd like to see in future teach-ins. We will see you in 1 month. It's tentatively going to be Saturday, March the 7th, with our next live teach-in. We will officially announce the date and time and the opportunity and give you the opportunity to sign up via an email that you'll get about 10 days before the event. Have a lovely weekend and enjoy the Super Bowl.